Good afternoon, dear students, alumni, and guests. My name is Professor Krishna Bielak, and on behalf of Warsaw University of Technology Business School, I would like to welcome you very warmly today to Inspirational Lecture. I want to welcome students and alumni of our university, Warsaw University of Technology, especially a business school, our partners, our guests, in particular from the Keynes School of Business, Baruch College, New York City University, Sheffield Hallam University, Goa Management Institute from India, the University of Salford in Manchester, Polimi Graduate School of Management, Politecnico di Milano, Baltic Management Institute in Vilnius and Brussels, HEC in Paris, and the Management Center in Innsbruck. Today, the inspirational lecture will be delivered by Professor Lin Peng, who is representing our partner, the Keynes School of Business, Baruch College, New York City University. Professor Lin Peng is the Krell Chair Professor of Finance at Baruch College and holds a visiting professorship at Princeton University. Her expertise includes ESG and sustainability and social finance. Professor Peng's research has been published in top academic journals and featured by the Wall Street Journal, Financial Times, and Reuters, among others. She has been named an honoree of AACSB 2024 Influential Leaders for her research advancing new knowledge and creating impact in business and society. Today, she will be delivering inspirational lecture on sustainable investing. But I would like to also take this opportunity before we start with her lecture to invite you to the next inspirational lecture, which will be delivered on 13th of March by Professor James Stevison from Baltic Management Institute in Vilnius and Brussels, with the topic Unleash the Power of Words in Finance. Now I want to wish you a good time with Professor Lin Peng, and after the lecture you will be invited to ask her questions on chat. So Lin, you are more than welcome to start your lecture.
Okay, very good. Thank you so much, Grazina, for this excellent opportunity to share my research and my expertise with the audiences across the in Europe and across the world. So it's really an honor and a privilege. So I'm gonna now start sharing my slides, and let me know if the slides look okay. Okay, so does it look good on your side?
Yes, everything is visible.
Okay, perfect. Okay, great. Okay, so the title of my lecture will be ESG and sustainability. Since we only have about 30 minutes and there's just so much to cover in the lecture, so I'll just give you like an introductory overview and be happy to provide more details. You have follow-up questions. I'm sure you have learned a lot about many reasons why climate change is important. My lecture will be focusing on its importance on the economy and what's its relevance to the financial market. So I'll start with, the climate change and the implications on economics and finance. Then I will give you an introduction to ESG, a word that many of you may have heard before, and sustainable investing. And then I will talk about the ongoing evolving landscape of regulations and the potential challenges that we face in this area. Okay, so what has climate change to do with economics and finance? Well, let's first look at some data. Okay, so the economic impact of climate change can be seen in this example of a press release on December, which is just 2 months ago, by the Swiss reinsurance company, okay, which is one of the major reinsurance companies in the world. So the press release basically acknowledged that this is the fifth consecutive year that the insurance companies have lost more than $100 billion, okay, from natural disasters, okay? And the press release also explained that, why are we having all these, more pronounced and more frequent natural disasters? Well, one of the observation was that, the last year, 2024, is actually the hottest year on record with 1.54 Celsius above the pre-industrial average. So what happens is that when we have a warming climate, it's gonna lead to more frequent occurrence of many of the natural disasters, including those disasters we observed in 2024. For example, in the US, in 2024, the US has been impacted by 2 major hurricanes and a high frequency of severe thunderstorms. So, and that make up for at least 2/3 of the global insurance loss for the year. And the press release therefore concludes that this is why investing in mitigation and adaptation measures must become a priority. And this is not just in the US, it's all over the world. So this is another report issued by another reinsurance company, major reinsurance company, Munich Re, in 2025. So it basically gives us kind of a whole picture of different continents, the kind of natural disaster related losses, right? So for example, in Europe, there has been major flood incidences in Germany, Italy, Poland, Australia, Czech Republic, and the overall loss exceeds more than $5 billion, okay? And not all of them are insurance. Only about 40% of these losses are insured, which means that a substantial fraction of those environmental disaster-related losses are not uninsured. And this happened, the natural catastrophe losses also happened in Asia, in China, Philippines, Myanmar, Thailand. There was earthquake in Japan, flood in China, and flash flood in even desert places. One would imagine that it's hardly likely to happen, but it happened in April last year in UAE. So this tells you that climate change affects people all over the world, right? So it's not just a developed country or developing country problem. Most recently, many of you might have seen on media that there has been very devastating wildfires in California. So it destroyed houses of some of the richest people in California, including many homes in the area that's called the Billionaires Beach, that's in Malibu's Carbon Beach, and with many famous and rich people. And the estimated cost of these wildfire is about $250 to $275 billion. So this is I think this is kind of another wake-up call that climate change affects everyone, rich or poor. So more broadly speaking, climate change have huge impacts on the global economy. So based on stress test scenarios conducted by Swiss Re, it shows that if no action is taken, then we're expecting to see 20% loss in the world GDP in year 2040. So these are huge numbers. This reflects the severe economic implications of climate change, and if we don't take any actions. Okay, so now changing the gear slightly, because I'm a finance professor and we're in a business school. Let's talk about what implication is environmental climate on finance and on business. So let me dial the time back to about half a century ago. Okay, and let's talk about the traditional view of finance and business. So in 1970, a very famous American economist from University of Chicago called Professor Dr. Milton Friedman, who is also the Nobel laureate in economics. So in his landmark article published on New York Times in 1970, he proposed this was called the Friedman Doctrine. Okay, so in this article, basically he laid out the argument on for what the purpose of a corporation is. So he explained that a firm's main responsibility is to its shareholders, and therefore the social responsibility of business is to increase profits. And this view that firms' main responsibility is on profits and responsible for the shareholders, this shareholder view of corporations has greatly impacted the corporate world. This notion has been influenced in important dimensions such as how do we evaluate the performance of companies, what rights do shareholders have, how do we design the executive compensation? What incentives do we want to provide to motivate the CEOs? What role do corporate directors play, and what corporate responsibility is? So this view was also formalized in a statement issued by an organization called the Business Roundtable. So Business Roundtable is, again, a hugely influential organization comprised of all the major CEOs of major US companies. So this is a very powerful organization. So Business Roundtable issued a statement in 1997 that a company's primary responsibility is to shareholders. Now, when you think about this, right, and you think about these shareholder view of corporations and these kind of profit driven motives, right? What are the potential issues that comes into your mind? Well, I'm going to use this cartoon to illustrate, right? So you have these people in caves, right? Some in business suits, right? Yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for the shareholders, right? So that's the problem of this naive shareholder capitalism, okay? And so this can be, this issue or this naive shareholder capitalism, the problem with it can be summarized into a term that economists often use, which is called externalities. Okay, so when we think about externality, what is externality? Well, so externalities are not all bad. There could be positive externality, there could be negative externality. So for example, when someone consumes or produces a good that also benefits a third party, that will be a positive externality. Examples of this could be that, hey, you work that not only reduces the congestion, but also benefits, you're getting more exercise. But on the flip side of the coin, there could also be negative externality, which means that when consuming or producing a good, that causes a harm to the third party. For example, air travel reduces commuting time, but it also causes an increase in pollution. So in terms of business, right, so there are examples of externalities that you can relate to, right? So for example, when a new car manufacturing plant is built in the area, and that's going to create a lot of new jobs for people in the local area. And the positive externality would be that, hey, it's going to bring a lot of wealth to the community. That's going to create demand for local businesses, a boost to the service industry, right? So that's going to be positive externality as a result of this new car plant. But the negative externality will be that, hey, this factory is also a huge industrial complex, and it emits large amounts of toxic gases, right? So the increased pollution will result in the area of, air quality problems, and people may suffer from diseases associated with airborne pollutants. Okay, so with more and more development from climate science, I think there's more awareness of investors, of the consumers about the importance of considering the corporation's impact on the environment and on the communities. So there has been change in the attitude from the corporate side. So as a result, the same powerful organization, Business Roundtable, in 2019, they issued a new statement on the purpose of a corporation. And they stated that a company's primary responsibility is to all stakeholders, not just shareholders. So what does stakeholders mean? It means that the other parties that the companies do business with or have impact on. This includes the customers, suppliers, employees, and local communities. So the view is that the notion of a corporation that you should care about all the stakeholders, one would argue that it's not woke, okay? It's actually consistent with capitalism. And the reason, as argued by Larry Fink, the founder and chairman of the world's largest asset manager, BlackRock, as he made it very explicitly in his 2022 annual letter to the CEOs. So he basically said that, well, stakeholder capitalism is fully consistent with the long-term sustainability, okay? So if you are a shareholder, okay, if the company pursues stakeholder capitalism, is actually consistent with maximizing the well-being and the expected returns of a long-term shareholder, okay? And why is that? Well, because only when the companies practice its business in a sustainable way, it can generate value for its long-term shareholders. Because, for example, right, a company that has is able to attract. If a company treats its employees well, the company will be able to attract more talented employers. They'll be more productive. They'll be more innovative, right? So that's good for the business in the long run. Okay. Similarly, if the company operates in an environment in a sustainable way, right, it's going to create a lot of synergies between the businesses as well as the local community. And also, very importantly, just like any risk, the risk associated with climate change, right, with ESG, that could also be a material risk for the companies. So therefore, for any company that you want to manage risk and you want to look at what are the risk factors that's going to influence your future operations, you want to just incorporate that in your framework. So ESG risk is another source of very important risk. So therefore, companies need to consider such risk with the same rigor that it analyzes the traditional measures, such as credit ratings, credit risk, and liquidity risk. Okay, so the next set of slides, we're going to talk about, in particular, what is ESG and what are the important factors that companies or asset managers want to take into consideration when they want to think about sustainable investing. So what's ESG? Okay, so the word ESG each represents a pillar in this three-pillar system. So more broadly, ESG refers to the incorporation of environmental, social, and governance factors in either corporate management or investors' portfolio decisions. So it matters both for investors as well as for corporate executives. So E, the dimension of E, environment, it refers to a company's impact on the natural ecosystem, such as impact or impacted by climate change, resource depletion, pollution, deforestation. S refers to the company's relationships with its employees, customers, and the community, the society. So it concerns things like working conditions, employee relations, customer privacy, customer safety, and human rights. The governance, the G, refers to the governance dimension, which captures the system in place for the management to act in the best interest of its long-term shareholders. So basically, the managers are the agent hired by the investors to run the company, right? So therefore, we want to make sure that the managers, the agents, make decisions that aligns with the best interest of the shareholders. So there are also other words that describe similar concepts people have used before, such as responsible investing or sustainable investing or CSR, corporate social responsibility. So what are the key players in this network of responsible investing? While you have asset owners such as the pension funds, the insurance companies, the sovereign funds, foundations, endowments, as well as retail investors. Then typically these asset owners, they delegate their investment to asset managers. So these are companies, financial companies such as BlackRock, Vanguard, State Street, Fidelity, JP Morgan, or Goldman Sachs. So these asset managers will help the investors make investment decisions. They will decide what type of asset classes they want to invest in, what kind of strategies. Do you want to do active strategy? You want to do passive strategy? And do you want to take active ownership and influence corporate decisions? And which market, right? Do you want to invest in Europe, in Asia, in North America to invest in? And you also have advisory firms. So these are investment consultants or brokerage and banks that provide services, provides additional advice to asset owners and asset managers in their investment decisions. There's also data providers and service providers. So these are ESG generalists, specialists that provide data that the companies can use to analyze the risks as well as opportunities that their business have along the dimension of ESG. And they can also help the investors to engage in proxy voting to influence, to actively influence corporate decisions. And obviously, like the bigger, the elephant in the room will be the regulators, whose regulation and policies will be able to affect everyone, all the participants in this responsible investing system. So let me kind of dive into this concept of, why should an investor think about responsible investment? Well, there are three main reasons, at least three main reasons. The first main reason is that it is a material factor that's relevant for business decision, okay? And there has been recognition both in the financial industry and in the academia that these ESG factors, they can substantially influence the risk and the return of your investment. The second reason is that there's market demand, right? There's what your customers want, right? So if the investors, if the pension fund comes to you and said, well, they want greater transparency about how their money is invested, right? What is the impact of their investment on climate, on local communities, right? So there's demand for more disclosure about companies' involvement in the ESG dimensions. And there is also regulation. There's been many guidelines issued from regulators that ESG factor or climate-related risk exposure is investors' duty to their clients and beneficiaries. Some examples, very high-profile examples of why ESG factors affect the risk and return of companies. So these are examples of financially material incidents. So the first example is the Deepwater Horizon oil spill, for which BP, the oil company, recorded more than 50 billion US dollar pre-tax charge because of the environmental spill. So that's kind of environment related major incident that the company suffered a huge loss from. The second example is a social it's an incident along the social dimension. Well, actually, so yeah, sorry, this is a governance dimension. So a few years ago, Volkswagen has been found to have rigged more than 11 million vehicles so that they can pass the emissions tests. And once that fraud has been exposed, that resulted in costs, including more than 27 billion in terms of penalties and fines, right? So basically, having performed poorly on the governance dimension is also very costly for the companies, for the shareholders. And the last example is a Facebook scandal, which means that what happened is that more than 80 million customers of the Facebook, their data has been harvested by this company called Cambridge Analytics. Then the data was basically stolen away from the customer without their consent. So this is an example of companies breaching the S dimension, the social dimension, because customers' privacy was not protected by the company. Okay, so the takeaway is that ESG factors, they substantially influences the company's financial performance. Okay, and more broadly, when we think about the risk exposure that a company have to climate-related risks, there are more broadly there are these two categories. One is physical risk, the other is the transition risk. So the physical risk basically refer to the natural events, adverse natural events such as droughts, heat waves, wildfires, as we've seen in my slides earlier, and flood. Okay, and then the transition risk is associated with when our society, when the world moves in response to climate change issues, there's again new technology developed, which makes the old technology obsolete. There's also policy shifts that makes heavy pollution companies more costly to conduct their business. There's also consumer preferences that consumers are going to be preferring the more green products and they're going to ditch the brown products. So as a result of both type of risk, the companies that fail to acknowledge these risks are going to suffer economic losses. For example, if they have not prepared for the more frequent occurrence of natural disasters, if they build their factories in kind of the flood-prone zones, they're going to occur damages to their infrastructure if there's a hurricane or if there's flooding, right? And for companies that refuse to transit their technology to kind of these more more renewable technologies, in the long run, they're going to suffer from stranded assets, which their existing assets that's highly carbon intensive the value is going to decline. And they also have this issue of inaccurate valuation that their current assets on their account does not fully reflect the cost of carbon that more and more countries and the regulators are recognizing they are taxing. So as a result of this, new realizations and considerations, we have seen a growing trend in sustainable investing. So this plot shows you the signatories of UNPRI, which is United Nations Principle for Responsible Investing. So this is the world's largest proponent organization for responsible investment. So the number of signatories have grown from initial days in 2006, about 63 signatories, managing assets of $6 trillion asset under management, to the latest in 2021. It's a bit dated, but you can get the sense of how fast it has been growing. And as of 2021, they have more than 5,000 signatories, managing assets of more than $121 trillion. Okay, so there's more money that's willing to take into consideration of sustainability in the long term. So what are the views of what are the reasons that are the primary drivers for investors' decision to incorporate climate risk in their decisions? According to a very nice paper published in one of the top journals, the primary reason, a lot of among the top 7 motives, right? So there's reputation and moral obligation, but also importantly, it is, they show that it is really business consideration. They argue that it's beneficial to their returns, it reduces portfolio risk, and it reduces the tail risk, which is the risk of extreme but devastating losses to their business. Okay, so due to the interest of time, I will just skip this climate change. So basically, the ESG issue that captures most of the public attention, especially in the recent years, is the company's exposure to climate change. So I will skip this. And finally, I will go through, what is the current status of ESG and sustainable investing, because we are actually currently facing some headwinds in that dimension, especially in the US, not so much in the Europe. Europe is actually one of the jurisdictions that has the most ambitious regulatory agenda. So starting from 2014, the EU has installed reporting requirements for the companies to report their ESG performance. And last year, there's more stringent corporate sustainability reporting directives called CSRD, which requires companies to disclose detailed information on how issues like environmental, social, and governance affect their performance and how their activities impact the environment and the society. So that was CSRD was for companies. Now, a similar regulation also in EU, that's for the financial market participants. For example, these are the asset managers and financial advisors. So there is this regulation called SFRD, Sustainable Finance Disclosure Regulation, which requires the company, for example, in 2023, to require the financial institutions to disclose their sustainability risks and the impact of their investment decisions on ESG factors. Okay, it also aims to combat greenwashing and ensure transparency on how these financial products consider sustainability risks and opportunities. Similar regulations also was put forth in the UK. In the US, the regulatory landscape is a bit more clouded. So finally, in 2024, after years and years of discussions and soliciting comments, as the US financial market regulator, SEC, had their climate-related disclosure, which requires public companies to disclose climate-related information in their annual reports and registration statements. So according to the SEC chairman, Gary Gensler, so the standardizing this information and turning guidance into firm rules would benefit both companies and investors. And the reason is that these are just disclosure, okay? This is neutral. You can use this disclosure to either go short green or long green. It's just disclosure, and it's just providing more information so investors can make more informed decisions. However, that ruling has met multiple legal challenges. So lawsuits have been filed in courts. Some states and business groups were seeking to block implementation, and as a result, SEC had to issue partial stays on the certain provisions pending legal resolution. And just like, as you probably are aware, and this ESG is highly politicized. In the US, there's huge polarization on people's attitude towards that. Republican states and Democratic states, they have very different views. So for example, in 2023, more than 100 anti-ESG bills was introduced by 37 states, mostly led by the Republican-leaning states. So that has created a chilling effect for green finance. One example is that a few years ago, banks and investors, they launched many of these green finance groups to show their commitment to fight climate change. But in the past months, the last several months in 2014 and the beginning of 2025, many financial institutions had to withdraw from climate initiatives. And they are citing one of the primary reasons was that they felt that being part of those climate alliances makes them vulnerable to criticisms and investigations from Republican officials. But so I was interviewed by a journalist from Washington Post, and this is my view. My view, as I shared with you, is that climate change irrespective of what, how you call them, whether they are part of the climate alliance, climate change is still an important part of how companies conduct business. It's just important business decision. Because, for example, if you are real estate companies, if you are insurance companies, you have to take into consideration how the wildfires or sea level rising risk change your exposure, right? So these are just important business decisions that you should take into consideration. And this view is consistent with the survey results by GARB, which is one of the major risk assessment providers, that they cite that out of the respondents of their survey, which is financial firms that collectively manage assets of more than $46 trillion, they cite that the reason for the climate scenario analysis is that they have to assess this is an important part of their financial risk impact, and identifying this risk is crucially important. Okay, so I will also just two more slides. One is that not only is important to consider climate change because it's risk dimension, but it also offers perspectives on where are the business opportunities. This is a plot of global investment in the energy transition, right? So as you can see that there's a huge growth in the total amount of investment in the renewable energy investments in the world. And I'll skip the slide because that's more to do with kind of US politics. So the point of all these is that climate change is not woke capitalism. It is sound business. It is related to the long-run sustainability of the company and the long-run shareholder value. So therefore, in the United op-ed that I jointly issued with three other business school professors, we made a strong case that it's very important to embed climate risk in finance teaching, because climate change, they are important risk considerations. Stocks exposed to climate risks, they're going to be less attractive investments. Considering climate change also offers opportunities when investors want to maximize their returns, because investing in climate change and sustainability has the potential to generate returns and make a positive impact on the environment at the same time. There's also government policies that these investments could utilize, and there are also opportunities for financing, such as green bonds and infrastructure. Okay, so with that, I will conclude that with rigorous analysis and the strategic implementation, I believe that sustainable investing can create value for both investors and the planet in the long run. Okay, so I end up with a very beautiful picture of Lhasa, which I had the opportunity to visit about 10 years ago. Okay, thank you very much.